Imagine you have $10,000 sitting in your bank account. You worked for it. You sacrificed for it. You said no to vacations, expensive dinners, new clothes, and probably a few things you genuinely wanted. And every month, you watch that number grow. $6,000, $7,500, $9,000. Finally, $10,000. It feels good. It feels responsible. It feels like you're getting richer. But here's the uncomfortable part. What if I told you that while the number in your account went up, the actual value of your money could have been going down? You didn't spend it. Nobody stole it. You didn't make a bad investment. And yet, you still lost purchasing power. And in a minute, I'll show you what can happen to $100,000 over 20 years without a single dollar leaving the account. Because this is the strange reality of money. Saving money is not the problem. But believing that saving money alone builds wealth? That mistake can cost you decades. And once you see why, you'll never look at your bank balance the same way again. Let's go back 10 years. Imagine two friends, Alex and Daniel. They're both 30. They earn similar salaries. They live in the same city. And after years of working, both have managed to save $20,000. Alex grew up hearing the financial advice almost everyone hears. Work hard, spend less than you earn, save as much as possible, and don't risk your money. So that's exactly what he does. He keeps his money safe. Every month, he adds more. Whenever someone mentions investing, Alex gets uncomfortable because investing sounds dangerous. Markets crash, companies fail, people lose money. But cash feels safe. Daniel agrees with Alex about one thing. You absolutely need savings. So Daniel keeps enough cash available for emergencies and expenses he expects in the near future. But then he asks a different question. Not, how do I stop my money from ever moving? But, how much cash do I actually need? And what should the rest of my money be doing? It sounds like a tiny difference. It isn't, because 20 years later, Alex and Daniel could have dramatically different financial lives. And the reason begins with something you can't see. Inflation. You've heard that word thousands of times. But forget the economic definition for a second. Here's what inflation actually feels like. You walk into a grocery store with $100. A few years later, you walk into the same store with the same $100 and walk out with less. The money didn't disappear. Its purchasing power did. And that's why inflation is so easy to underestimate. If you have $10,000 in the bank today, tomorrow morning, your screen might still say $10,000. Next month, still $10,000. There is no warning, no red number, no notification saying, your money became slightly less powerful today. Nothing. Your balance looks safe while the world around it becomes more expensive. That's the first illusion. We measure our wealth by how many dollars we have, instead of what those dollars can buy. Let's make this painfully clear. Suppose you put $100,000 somewhere earning zero return. You don't touch it. You don't lose a dollar. You don't spend a dollar. 20 years later, your statement still says $100,000. Looks perfect. But assume inflation averaged 3% during those 20 years. What would that $100,000 have roughly the same purchasing power as in today's dollars? Not $90,000, not $80,000, not even $70,000. Roughly $55,000. Think about that. Your account says you lost nothing. But in terms of purchasing power, almost half of the original value has been eroded. And that's the kind of loss most people never emotionally experience as a loss, because nothing disappeared from the account. Now, this is a simplified example. Inflation doesn't stay at exactly 3%, and cash doesn't necessarily earn zero. But the principle is what matters. A stable number does not necessarily mean stable value. And suddenly, playing it safe becomes more complicated than it sounds. Now, before someone empties their savings account after watching this, don't. Cash has a job. Actually, several jobs. If your car breaks down tomorrow, cash is useful. If you suddenly lose your income, cash is useful. If your furnace dies in January, cash becomes extremely useful. If you need money 6 months from now, putting all of it into a volatile investment because someone online said cash is trash would be reckless. Cash is excellent for liquidity. It's excellent for emergencies. It's excellent for short-term obligations. The mistake is expecting cash to do another job, build long-term wealth by itself. Because saving and building wealth are connected, but they aren't the same thing. Go back to Alex. His $20,000 becomes $30,000, then $40,000, then $50,000. Every milestone feels like progress, and it is progress. But there's something his banking app isn't showing him. There are actually 2 scoreboards. Scoreboard number 1, nominal wealth. That's the number you see. Scoreboard number 2, real wealth. That's what the number can actually buy. Imagine Alex's savings grow 2% in a year. His number goes up, but prices rise 4%. He now has more dollars and less purchasing power. Both can happen at the same time. That's the trap. The goal isn't simply to make the number bigger. The goal is to make your financial capacity stronger. Daniel understands this, but he isn't some Wall Street genius. He's not trying to predict tomorrow's stock prices. He's not buying random cryptocurrencies because someone posted a rocket emoji. He's not day trading from his phone during lunch. His strategy is almost disappointingly boring. He maintains an emergency fund. He avoids destructive high-interest debt. And money intended for long-term goals is gradually invested in diversified productive assets, appropriate for his circumstances and risk tolerance. Why productive assets? Because productive assets have the potential to generate economic value. Businesses generate profits. Bonds can pay interest. Real estate can generate rent. Investments can compound. Of course, none of that is guaranteed. Markets fall. Companies fail. Property values decline. There are bad years, sometimes terrible years. Daniel knows that, but he understands something Alex doesn't. Risk isn't just, could my account balance fall? There's another question. Could my purchasing power slowly disappear? One risk screams at you. The other whispers. Now, let's put numbers on this. Alex and Daniel each have $10,000 they won't need for emergencies or near-term expenses. Alex keeps his $10,000 somewhere earning essentially nothing. Daniel invests his $10,000 for the long term. For illustration only, let's assume Daniel averages 7% annually. That's not a promise. It's not a forecast. Real investment returns are uneven and uncertain. We're simply demonstrating what compounding can do mathematically. After 10 years, Daniel's $10,000 would be roughly $19,700. After 20 years, about $38,700. After 30 years, around $76,000. But here's what matters. Daniel didn't work 7 times harder. He didn't save 7 times as much. He gave his money something Alex didn't. Time, combined with return. Eventually, the money itself starts contributing to the result. That's compounding. When you only save, your income has to do almost all the heavy lifting. When capital compounds, time starts working with you. But most people don't save $10,000 once and then stop. So let's make this more realistic. Suppose Alex and Daniel both begin with $10,000, then both add $500 every month for 30 years. Same discipline, same contributions, same amount of time. Their total contributions would be $190,000. Now imagine Daniel's money purely for illustration, compounded at an average 7% annual rate over those 30 years. His ending balance could be around $690,000, same contributions, same 30 years, but a dramatically different outcome. The difference wasn't salary, it wasn't working more hours, it wasn't some secret side hustle, it was what happened to the money after it was saved. Of course, actual returns could be lower. They could be higher, there could be brutal crashes along the way. Taxes, fees, timing and account type matter too. But the lesson is simple. Saving determines how much capital you create. Compounding can determine what that capital eventually becomes. And this is usually where someone says, "But investing is risky." Absolutely. It is. And anyone pretending otherwise is selling you something. Stocks can crash. Real estate can fall. Bonds carry risks. Businesses fail. But here's the question most people forget. Risky compared to what? Because doing nothing is also a financial decision. Keeping excessive cash for decades exposes you to inflation, opportunity cost, and potentially decades of lost compounding. There is no button labeled, "No risk." There are only different kinds of risk. Market risk is visible. You can watch your portfolio fall 20%. Inflation risk is quieter. Your bank account can look perfectly healthy while your purchasing power deteriorates. And psychologically, we hate the visible loss much more. Imagine investing $10,000. 6 months later, it's worth $8,500. You open the app, red numbers everywhere. Your brain screams, "I lost $1,500. Now imagine you leave $10,000 in cash while prices rise. You open the banking app. $10,000. No red numbers, no scary chart, no pain. But the things you want to buy cost more. That's why cash can create such a powerful illusion of safety. Humans react intensely to visible losses. Invisible losses barely register. And sometimes we choose the option that feels safer today, even when it may be weaker for our long-term goal. This is one reason wealthy people often measure wealth differently. Think about some of the richest people in the world. Their wealth isn't primarily a mountain of cash sitting inside a checking account. It's ownership, shares in companies, businesses, real estate, intellectual property, assets capable of producing economic value. That doesn't mean wealthy people don't hold cash. They do. Cash provides liquidity, flexibility, and protection. But cash is usually part of the system, not the entire system. There's a huge difference between accumulating currency and accumulating productive ownership. So instead of asking, how much cash does someone wealthy have? A better question might be, what do they own? But now we need to avoid the opposite mistake, because someone could hear all of this and think, great, I'm investing my emergency fund tomorrow. That's not the lesson. Imagine losing your job during a recession. Your paycheck disappears. At exactly the same time, the stock market falls 30%. Then your car needs a $3,000 repair. If all your emergency money is invested, you may be forced to sell assets while they're down, just to pay your bills. That's exactly what an emergency fund is designed to prevent. So this isn't saving versus investing. It's saving and investing with different jobs. Think about your money in 3 simple categories. Money you need now, money protecting you from emergencies, and money intended for the distant future. The first needs liquidity. The second needs reliability. The third has a different challenge. Time. Money intended for retirement or financial independence may need to maintain purchasing power for 20 or 30 years. And that's where leaving everything in low-yield cash can become expensive. Your emergency fund isn't failing because it doesn't make you rich. That's not its job. Just like your long-term money shouldn't necessarily be judged by how stable it looks tomorrow morning. different money, different timelines, different jobs. And not all cash is equal either. Money earning essentially zero is very different from cash earning interest. When interest rates are higher, savings accounts or other appropriate cash vehicles can generate meaningful returns. There may even be periods when those returns keep pace with inflation, which is why this entire argument cannot be reduced to bank bad, stocks good. The better questions are, what is this money for? When will I need it? What return is it earning? What risks am I taking? And what happens if I leave it here for 20 years? That's financial planning, not blindly saving and not blindly investing. Now return to Alex and Daniel one final time. Alex wasn't foolish. Actually, Alex mastered something millions of people struggle with. He lived below his means. He controlled his spending. He saved consistently. He built discipline. Those are powerful habits. His mistake was believing the journey ended there. He treated saving as the destination. Daniel treated saving as the beginning. Saving created stability. Then his long-term capital had the opportunity to grow. That's the relationship. Saving creates the gap between what you earn and what you spend. That gap becomes capital, and then you decide what job that capital should perform. Some protects you, some pays for things, some waits, and some gets the opportunity to compound. That's the real problem with the phrase, just save your money. It's incomplete. Saving is incredibly important, but what happens after you save matters too. Because if your entire financial strategy is accumulating more and more cash for decades, you might eventually discover something painful. The number went up, but the life that number can buy didn't improve nearly as much as you expected. And that is the brutal truth behind this video. Saving money isn't literally making you poor, but saving while ignoring inflation, opportunity cost, and decades of potential compounding. Saving protects your money. Investing gives it a chance to grow, so keep saving. But never mistake saving for the finish line, because building wealth begins with what you do next,